Hello, I'm Margaret Doyle and I'm the Head of Financial Services and Real Estate Research for Deloitte UK. I'm delighted to be joined today by Mark Ward, Head of Investment Management, and Andrew Power, Strategy Partner, to discuss with me the recent Deloitte UK paper on meeting the UK's long-term savings challenge. Mark, if I may start with you, why did Deloitte write this paper?
Well, this is the first paper, the first chapter, if you like, in a series of papers under the heading Funding Our Future. We believe that the UK is at a critical point in its economic history. We're enjoying increased population growth through immigration, but also through the impacts of longevity. That is going to have a positive impact for our economy. It brings with it, however, some challenges around creating an infrastructure to support the growing population and the economy, but also, and more specifically to this paper, it brings some challenges around long-term savings.
Andrew, Mark has talked about a retirement savings challenge. You've actually specifically estimated how much that is right now and how much it will be in 2050. Can you tell us more?
Yes, Margaret. So about 5 years ago, we estimated the retirement savings gap in the UK was £318 billion. We actually estimate now it's gone up to £350 billion. But there's a couple of factors to take into account. First of all, there's some improvement based on a couple of government policies that were introduced. One was auto-enrolment, and secondly was raising the retirement age. That actually reduced what the gap would be. However, offsetting that has been three things. One is around longevity, secondly, increasing long-term care costs, and thirdly, the essential end of defined benefit plans.
Okay, so Mark, this £350 billion retirement savings gap, how does that translate into an opportunity for investment managers?
Well, I think you've just said it. I think that there's a gap in savings of £350 billion. That gap will not be met by government, therefore the private sector has to fund that, or has to provide the mechanism for that gap to be funded. It will be yours and my savings over the long term that fund that gap, and we will rely on the industry, specifically the investment management sector, to provide the product to help us save for our retirement.
Now, people have spoken about this gap for some time, but why is now the time to act?
Well, I suspect the right answer was that yesterday was the time to act, but inevitably we are where we are today. I think the government has expressed its intention to assist in addressing this gap, and I think now is the right time for the industry to start responding to some of the challenges there and to make it simpler to provide for our own retirement.
Andrew, traditionally it would have been the government's job either to provide for people in the old age or to ensure that they or their employers did so. So what has changed now?
Well, probably a couple of things. One is in terms of the general fiscal situation in the UK. So the government can less afford to provide tax incentives for people. And we've already seen that in terms of some of the pension reforms that have taken place that have reduced the tax incentives. However, that's not to say the government can't do anything, as I talked about in terms of the retirement saving gap. Creating auto-enrolment and raising the retirement age has made a substantial difference, but probably going forward, there's less that can be done there by the government.
So basically, it's for the industry to step up now, Mark.
Yes, I think the industry has a role to play, but as I said at the beginning of this conversation, I think it's looking at the combination of the industry, the policymakers and the regulators that will provide the solution to this long-term savings issue.
Andrew, of course, if this were simple to solve, it would probably have already been solved. What are the hurdles that prevent people from saving enough for their retirement?
Absolutely. The retirement savings gap has been outstanding for quite a while. And probably the key hurdles that we see is one, what economists call behavioral economics, in terms of consumers prefer to consume today rather than save for tomorrow. Secondly, the industry is quite fragmented. There are a lot of pension schemes, a lot of investment managers, and therefore you lack economies of scale. Thirdly, there's an opportunity, much better return on investments through asset allocation and maybe lower costs. And lastly, particularly with pension freedom that's just come in, there's a need for more flexible solutions to meet the needs of retirees and upcoming retirees.
Mark, lots to contend with there. How do you think the industry can address the four hurdles that Andrew has just outlined?
So I think it starts with simplification. I know it's a word that's been used in this context before, but what I mean from that is actually helping people understand what their own retirement challenge might be and actually how they are doing along the road to meeting those goals. So I would say, firstly, It's about developing a solution, as they have done in some other countries, including the Netherlands, for example, where each individual's pension savings are aggregated and visible. So you and I could see, for example, over the course of our career, how our pension savings were building up. Secondly, we clearly need to have a lower cost solution for the industry to provide better product. I think that will be principally driven by technology. Thirdly, and very importantly, and it links to the simplification concept, is actually the behavioural science thing. Let's find a way to engage with customers, investors, savers in a way that doesn't shut them out, that isn't loaded with jargon, that is transparent and simple. And the fourth is recognising that not one size fits all. We need to have tailored product outcome. The buzzword, if you like, is outcome investing. We may have different objectives at different stages of our lives, and the industry needs to help design those products that meet the individual's needs in a low-cost environment.
So Andrew, simplification, aggregation, tell us, how would that work?
So there's a number of different models. As Mark mentioned, the Dutch pension register, where basically all pensions, both state and private, are in one place. And it's been talked about in the UK in terms of bringing together, typically people may have 7 different pension pots. And therefore it's very difficult for them to understand what their savings are. So if you can bring together in one place state pensions, potentially defined benefit, and all the defined contribution pots, by seeing what people are saving, they can understand the gap, they can plan better for their future, and therefore make better decisions whether they do it themselves or on an advised basis.
Mark, can you explain a little bit about how the industry could use technology to help counter those behavioural biases against saving?
We're seeing a lot of embracing of a digital component, if you like. If you look at the sort of traditional savers and pensioners, they tend to be perhaps slightly older generation. One of the challenges is engaging the younger generation at this stage so that their retirement savings are fully funded from an early stage. As we know, younger generations are more comfortable with digital media, with social media. So you might have, for example, apps on your iPhone or connection through your iPad or something that enable you to both engage with your own retirement savings, but also perhaps importantly with the provider of that. One of the examples that we've seen in the marketplace is the Retire Ready solution from Aegon. And what this Retire Ready solution does is it enables you, subject to answering 1 or 2 questions around your age, your savings and your ambitions for retirement, to explore how ready you are for that retirement. And then Aegon use that to engage with you to help you think about how you might plug that gap through, I guess, investing in some of the products that they provide.
Andrew, you talked about boosting net returns. Easy to say, tough to do, I suspect.
Absolutely, that's probably the holy grail, but there's obviously both elements of it. There's the actual return on the investment and the costs associated with that. The return on investment is probably going to be around different asset allocation in terms of more towards infrastructure, more towards housing, more towards health and type investments. That meets the economic need and provides potentially more attractive returns. Then at the same time, costs can potentially come down using technology Mark talked about. And if you look in other markets, particularly the US, investment costs are substantially lower because there's more use of technology and there's more economies of scale.
Mark, you've both alluded to the complexity of the landscape right now. How does the industry respond to that in terms of providing those tailored solutions?
Well, I think Andrew's addressed it. I think there is pressure around cost of provision of product. I think there are new competitors in the landscape who are driving that through, whether it's through the offer of passive solutions at lower cost or alternative product. I think the industry will need to respond in order to remain profitable.
Great. Well, very much for the industry to contend with. Mark and Andrew, thank you very much for joining me. And I hope that you enjoy reading our paper on meeting the UK's long-term savings challenge. Thank you for joining us.